You're hopefully aware that the research team just yesterday published the Bible, or the results preview expectations for the upcoming February reporting season. And step two, or stage two of that, is each of the supergroups running through their key stocks to watch. So we're kicking it off today with the tech, media, telecom, and gaming sector. So that's Steve Sassine, James Filius, Leo Partridge, and myself. And we're just going to talk through some of the key stocks that we think are of relevance to the network. So I'll kick it off on the tech space. Just before we dive into actual names, I think it's always useful just to step back and look at the long-term valuations. These two slides here, or two charts you can see, is basically Australian tech and US tech and 20-year valuations. So we're looking at the average PEs over a 20-year period just to get a feel for optimism versus pessimism. It's hard to find the right basket, but we've really taken the legacy tech names. So for instance, in Australia, the likes of Technology One, Seek, Car Sales. In the US, SAP, Oracle, those sort of long-standing, profitable, stable businesses. And to cut a long story short, in both instances, they're trading a little bit above fair value. That really underpins our neutral view on the technology sector. Of course, the technology sector is a pretty broad area. So we do also try and break it down into the emerging companies, or the Australian software as a service companies. So Xero, Megaport, WiseTech, those sort of names. Clearly, they don't really have a 20-year track record, but we've done our best to give you a feel for that. The one I'm, more comfortable with is the EV to EBITDA multiple on the right-hand side of the screen there, where you can see things are trading just a little bit cheap in the software as a service side of things. So a little bit of value in the emerging names, pretty close to a little bit of valuation in the kind of legacy tech names. And just quickly mentioning, the tech sectors performed really strongly on a 1, 3, and 12-month view, significantly outperforming the broader market. It is a good space to be in, and we do have a preference. We like the sector, but we've just got to be selective about the names rather than buying the broader sector based on where we're standing today. So if I kick into key results to watch, Megaport's my one that I expect the most amount of volatility on. This is a stock I'm very happy with, but we do have a hold on the stock. The key reason really is they release a second quarter next Tuesday, and the company's been very, very clear that it's going to be a tough quarterly. But the interesting thing with Megaport is the market always seems to get surprised on this name. So if you look back on the last two quarterlies, the stock has moved very strongly up or down, close enough to 20% a day on those results, and we're just a little bit nervous that could happen again. So management have clearly flagged it's going to be a tough quarter. We do think that revenue growth is going to be very slow because it's a seasonally tough period. And secondly, currency is going against them, so that's not going to help. The third thing to bear in mind is that costs are lifting in this quarter on higher sales and marketing. Now that's actually a really good thing. They've basically hired 20 sales people, so doubled their sales force, and that will clearly drive some returns over the next 6 to 12 months. But initially, you've got to invest up front. So point being, some fairly anemic revenue growth combined with higher costs will mean EBITDA and free cash flow will decline quarter on quarter. In this quarter, they'll be up year on year and certainly heading in the right direction, but we're just thinking you may get a good buying opportunity in this name if it pulls back. The next stock I wanted to talk to was NextDC. Two things to bear in mind on this stock. Firstly, energy prices have been clearly very volatile in Australia over the last couple of years, and that's going to impact the first half, second half EBITDA skews. There's a lot of power pass-through in NextDC's business, and basically what that means, given the movements in energy prices, is you're going to see a bit more EBITDA in the second half as they basically make good on power prices. So that's one thing to be conscious of, a stronger than usual second half skew, which means that you might actually see EBITDA drop year on year, and the second, just for the half, I should say, and sort of broadly flat for the full year. And the second thing to bear in mind is what really moves the dial on the price for NextDC is contracts, and management have quasi-guided to 40 to 60 megawatts of sales this year, FY24. They did close enough to 20 in the first half, so obviously the market's expecting somewhere between 20 and 40 in the second half. We haven't seen anything yet, but we're hopeful we'll get something towards the end of June of this year. We saw Canberra Data Centres, or CDC, a competitor in Australia, just announce a couple of big deals. So deals are happening. Typically, those big deals are put in multiple locations, so we remain optimistic that will happen. But I guess the key question is, what's management's confidence around those megawatts contracted dropping, and that will drive the share price. I just really quickly wanted to touch on Data3. It's performed really, really strongly. They've already upgraded guidance, and the share price has run on the back of that. I guess the key thing just to bear in mind is that is largely a non-operational upgrade. So this is probably one of the first stocks we've seen have a big upgrade because of the RBA having higher rates. So basically their interest income on their large net cash balance was a couple $1 million higher than expected, and that's really moved the dial for these guys. So a really good result, but should it be capitalised going forward? Probably not. So it could just disappoint a little bit when the result comes out because they don't provide much in the way of outlook. So that's Starter 3, and my last stock in the technology space is Ansarada, which is our key small cap pick. It has performed really well over the last 12 months. I'm just conscious that everyone, the insiders, I guess, in the equity markets are looking around and seeing that capital market activity is really kicking off, and maybe a little bit of that expectation is happening with Ansarada. My expectation for the result that they'll release next week is that that hasn't really flowed through yet. We think it will, but we think it'll be another 3 to 6 months before Ansarada sees their really large group of non-paying subscribers convert to paying subscribers. So this is a stock we really like in the long term, but we'd probably just wait for the quarterly results before doing anything on that name. And I'll pass over to James to touch on two of his.
Yeah, thanks, Nico. Look, just on my two stocks, I haven't necessarily called out either of them as upside or downside contenders coming into this reporting season. So I thought it was probably just worth highlighting some of my thoughts coming into this result and some of the things we're looking toward. So firstly, on WiseTech, I guess the key driver coming into this result that we're going to be looking closely at is the continuing build and rollout of large global freight forwarders in the process of global rollouts on the WiseTech CargoWise platform. Historically, this has been about 10% of WiseTech's 33% CAGR growth since its IPO. The company flagged that at its June result, they had about 14 large global freight forwarders in the process of global rollouts, of which they had around 40% of their intended users actually live on the platform. So, there is some runway for user adoption coming into this result. And additionally, I guess the other thing we're looking at is, Kuehne+Nagel and FedEx, both which are already CargoWise customers. They committed to the global rollout of WiseTech's customs module. Why is this important? It's the early stages of the adoption of large global freight forwarders of this product, and it's a product that WiseTech believe represents a similar size addressable market to its core freight forwarding offering. So we'll be looking for progress on further adoption of this product. Secondly, I think the thing we called out in the Bible is that as per WiseTech's FY23 guidance, we're expecting the first half result to show EBITDA margins dip to a low point as the group wears near-term margin erosion from its M&A last year, and it's decidedly pulled forward some R&D projects. So we're expecting the first half EBITDA margins to land about 42 to 43%, which compares to around 50% margins that they'd previously achieved. But ultimately, they expect this to recover in its outlook statements over the next few trading periods and over the next couple of years as they start to see accelerated growth from this investment. So as it stands, we'll be looking for any comments around how this investment will accelerate growth in the company's outlook. We currently have a hold on it just on valuation. It seems to be trading around that fair value, but yeah, we'll be looking for potential read through on any upside on how it's trading. Nextly, on Objective Corp, coming into this result, there doesn't seem to be a lot of dispersion in consensus. So I think it's reasonable that a lot of the analysts on this stock are looking for fairly similar outcomes for the company, which is really for earnings momentum to return to the stock this year after a slower year last year. We're expecting ARR growth to show signs of improvement from its second half 23, where the company called out there were some one-off factors that caused a bit of a drag on ARR growth in the second half. Consensus is looking for about 100 mil, that 100 mil milestone for ARR in the first half, which is around 13% growth year on year. Versus Objective Corp's net ARR growth target of around 15% that they've called out. The company's increasingly invested in the return to travel and invested in sales team to try and drive ARR growth this year. And we expect to see that return on that investment start to come through, particularly as the group looks to convert some of its legacy customers to its Nexus SaaS offering, which it expects to drive around 1.5 to 2.5 times revenue uplift for those particular customers as they convert them. We also note for this period, this will be the first period in which Objective Corp reports its accounting changes, the recognition of its R&D spend, where it will start to capitalise some of its costs. Drilling through that, we're looking for signs of margin improvements this year as the company looks to return its margins to its sort of historical levels. And then finally, for Objective Corp, the company, has been talking about M&A for a long time. At the AGM, they reiterated that they're planning on adding, additional companies potentially to their stable in FY24. And we see the company is still having strong cash flow generation and an ample room in their balance sheet to undertake highly accretive M&A. So we'll be looking for this in this result too. So with that, I might hand back to Nick or Steve.
Thanks, James. I was just going to quickly touch on the telecommunications sector. So two big names to be aware of, Telstra and TPG. So Telstra, we don't think will really surprise. They have obviously got guidance for the full year. And the second thing is they've guided to having a stronger second half than usual. The interesting thing is consensus actually doesn't have that at the moment. So you need to see some EBITDA move out of the first half and into the second half for Telstra, but it shouldn't change the full year number. To me, we're expecting some strong mobile performance, but the key thing for Telstra will people reassess the valuation framework here? Bearing in mind, we think it's in the expensive defensive category. It's trading at a PE well above its long-term average, and you've basically got to hang in there for 3 or 4 years of growth for that to get back to fair value, which we think is likely, but we think there's better value elsewhere. So it'll be interesting to see if other people look at it that way at this upcoming result. Secondly, TPG, they've got a full year result. I think it's just interesting to note that just this month they've pushed through their biggest ever price rise. So 12 months ago, they put their first ever price rise through for the Vodafone postpaid business. You'll be aware that Optus has had a couple of own goals or serious challenges over the last 12 or 18 months, and it looks like Vodafone is capitalising on that and have actually increased their prices nearly 20% just this month. And I've checked that data point a couple of times. It looks like it's a permanent change, not just a temporary price thing. So point being, that's quite a material price rise, 20%. If that flows through to the entire back book, because right now it's just on the front book or the new customers, if that flows through, there is actually a little bit of upside risk, I think, to EBITDA for the year ahead. So that's one just to be conscious of. And with that, I will pass over to Steve.
Look, first and foremost, Seek, obviously it's a business that's undergone a pretty substantial tech change, tech refresh over the last couple of years. It's had that sort of platform unification program. It's expected to complete at the end of FY24. Just a reminder, it's been basically a 3-year, $180 million project, $100 million of which was OPEX, 80 mil CAPEX. So it's been a pretty meaningful cost impost these past few periods. So it's effectively a CRM rollout built around Salesforce, and it unifies all of APAC on the one system. They've also basically done a unified enterprise resource planning system as well. So 2 big major tech refreshes over the last 3 years. So quite a lot of money has gone into it. Simply put, it just means Seek can now offer its ANZ products, its contracts, its marketing across all its regions, enhancing its overall scalability. So it should hopefully be a big driver of leverage in this business in the medium term. But back to the result, I mean, why is it an interesting result from my perspective? Like 2 points, really. First and foremost, Seek provides guidance, right? You can see that on the slide. It was reiterated at its AGM in November. And we know based on our site scraping, as well as their monthly employment reports, that volumes have obviously reverted since their time series highs over COVID. we had job ads down about 20% in the period. We know ourselves and consensus kind of pinned to the midpoint of guidance. So for me, I guess the big question is how is yield? And that's just, basically their pricing of job ads as well as depth adoption. Has that been enough to offset this volume decline? And is that enough to warrant guidance remaining where it is? I suspect it should be, but we'll get a better idea at the actual result itself. I think if there's sort of any pullback, it's probably worth looking at. I can see candidate engagement is definitely up. It's up about 6%, month on month. And for me, that augurs well for their dynamic pricing strategy, right? So they can basically flex up and down the pricing based on demand and geolocation for their job ads. They've got 31% share of overall placements in ANZ, and that's 3 times its nearest competitor. So 90% unprompted brand awareness. So they definitely have that number one position locked in. Secondly, the other key point is Seek Asia, right? With that unified platform, they have seen a decent increase in their yield per ad. It was up about 28% in absolute terms in FY23, mostly on increased depth adoption. For me, it's going to be an important driver of this business in the medium term, particularly if they want to hit that sort of $2 billion aspirational revenue target they set by FY28. And it's something the market hasn't sort of factored into the numbers. We've got 1.75 bill. That's probably where consensus is. So they've got a bit of legwork to get the market to believe that $2 billion target by FY28. But at current levels, it's trading around 19 times FY24 EV to EBITDA. That's a tad under its 10-year average. So the valuation still looks undemanding versus its peers. So as I mentioned, if they do sort of shake a little bit on result day, it's probably worth having another look at. The second one is our smaller pick. That's Camplify. Look, it's one I'm sure the network knows really well, and I've spoken about it recently. But for me, it's going to be business as usual in terms of its ANZ business. Forward booking should still be robust given we're in the peak season. They were sitting around 30 mil at the end of the first quarter. Don't forget, they'll be cycling some pretty strong TAP numbers, and that's that temporary accommodation program. But the outlook should be okay, given they have like an 8-week lag between a natural disaster occurring and the van sort of rolling out into those areas. And I know, having spoken to the company just before Christmas, they are in talks with the Queensland government around some of the natural disasters that have occurred up there. But there is going to be a bit of a lag in terms of the vans actually rolling out and then revenue coming through. In terms of the European business, look, expect some commentary around the MGA. That's that managing general agency. It's their insurance arm. They've soft launched it just prior to Christmas, selling insurance products and accident excess reduction into that market. It's going to be a slow burn, as we know. The Australian business has about 40% of their vans on that premium membership product, 25% in New Zealand. So it's one that's going to be, think of it as a medium-term revenue driver and as an adjacency to their actual core platform. But look, it's trading around 220. I've got a 285 price target. I do like it, and it is our key pick in the small cap space. So with that, I'll hand over to Leo.
Early in the month, I spoke to the network on my coverage being gaming and my thoughts on coming up to the reporting season. Today, instead, I'm just going to be running through my result to watch, which is going to be Star. And it's just the name that I've received the most inbound interest on. And I have flagged it for a negative surprise candidate. So for those unfamiliar, the Star's been in for the past 24 months under a regulatory minefield. And the share price is currently trading at all-time lows. I thought I'd share my earnings expectations ahead of a really widely followed result. So I'm expecting revenue to come in for the 6 months up to December 23 to be well below consensus. And very weak. This means that the skews are closest to 50-50 for some time. Keep in mind that for casino operators, the ramp-up period is really all the way up to December. So where does that put me in terms of my EBITDA expectations? So EBITDA is a number that we focus on. I sit currently at 124 million for the first half, and that's more than 10% below consensus. So there's a few reasons how I've got here and why I'm comfortable to be here. First reason is that I don't believe they haven't seen much of a material uplift from the trading figures that they announced throughout the 3 updates in the second half of last calendar year. Just after speaking with management, it seems like conditions have remained muted and they're still yet to see some of that benefit from the inbound international tourism. Second point would be that of the 10 plus analysts that actually covered the name, only 2 have really updated numbers. and this ultimately has to come down before the result. So despite this negative news, it's not going to take much to move this thing, and a lot of people are just waiting on the sidelines just for that looming Austrac fine and the other potential catalysts that I've listed on the screen behind me. On a PE basis, this thing doesn't scream cheap, but however, given that the numerator is the handbrake here, I think that there presents an asymmetrical risk to the upside given where expectations are at the moment. As I said earlier in the month, if you buy this thing today and sold it in 12 months, I think you're going to make money, but it obviously comes with its risks. In saying that, given my expectations around weaker trading, I wouldn't chase it ahead of the result. But if it gets smashed on the day of the result, then it might be worthwhile picking some up in a short-term horizon, given the notable catalysts ahead. In summary, we've touched upon tech, media, telecommunications, and gaming. You've heard all of our key stock ideas. So just reiterating myself, Star, I've got it as a negative surprise candidate just off the back of weaker trading and an outlook. Nick's pick is Megaport. If that thing comes off on the quarterly, it represents a buying opportunity. James likes Objective Corp. You heard about earnings momentum and the potential for capital management. Steve's a fan of Camplify and Seek.